Today, we will examine an important macroeconomic question. Is the government of India an efficient allocator of capital, and what are the implications for economic productivity and equity markets? In this presentation, we will analyze three major themes. First, government capital efficiency. Second, the impact of public spending leakage. And third, what this means for the Indian equity market outlook between 2025 and 2028. Let us begin by understanding the size of government relative to the economy. Contrary to popular perception, India does not actually have an unusually large government. Government spending is around 27 to 29% of GDP. In developed economies, this number is typically between 40 and 50%. India's tax to GDP ratio is also relatively modest at around 17 to 18%. So the real issue is not the size of government. The real issue is efficiency of capital allocation. Over the last decade, India's tax collection has grown dramatically. Central government gross tax revenue has increased from about 11 lakh crore in 2014 to roughly 35 lakh crore in 2024. This represents nearly a threefold increase. Key drivers include GST implementation, digitization of the economy, improved compliance, fuel taxes, and expansion of direct taxes. The government today has significantly more fiscal capacity than it did a decade ago. But the more important question is how this money is used. More than half of the government budget is allocated to non-productive expenditures. Around 20% goes toward interest payments, 13% toward defense, 10% toward subsidies, and another 20% is transferred to states. Only about 16 to 18% of the budget is actually spent on capital expenditure. This structural allocation limits the productivity of public finances. Despite these constraints, the government has significantly increased infrastructure spending. Capital expenditure has grown from about 1.9 lakh crore in 2014 to nearly 11 lakh crore in 2024. This is roughly a six-fold increase. The policy objective is to create economic multiplier effects through infrastructure investment. Road projects typically have a multiplier of around 2.5 times, railways around 2.2 times, and power infrastructure around 1.8 times. This is where the efficiency debate becomes most interesting. Public sector enterprises consistently generate lower returns on capital compared to private companies. In banking, PSU return on capital is typically 6 to 10%, while private banks generate 15 to 20%. In power and manufacturing, the pattern is similar. Private sector firms generally produce roughly double the capital productivity. The reasons include bureaucratic decision-making, political interference, lower accountability, and inefficient procurement processes. When state assets are transferred to private ownership, productivity often improves significantly. Examples include Hindustan Zinc, Balco, and VSNL. After privatization, these firms became globally competitive and significantly more profitable. Historically, productivity improvements of 2 to 5 times are not uncommon following privatization. Beyond financial returns, another critical issue is capital leakage. Government expenditure is affected by multiple inefficiency factors, including corruption and rent seeking, bureaucratic overhead, project delays, and poor project selection driven by political incentives. When these factors are combined, effective capital utilization may fall to roughly 50%. In other words, 100 rupees of government spending may generate only 45 to 65 rupees of real economic value. Time overruns are often more damaging than corruption itself. Approximately 40 to 50% of large infrastructure projects in India face delays. Average delays are typically 2 to 3 years. Cost overruns average 20 to 25%. As a result, a project expected to generate a 10% return may end up generating only 4 to 6%. At the macro level, capital efficiency can be measured through the incremental capital output ratio, also known as ICOR. This metric indicates how much investment is required to produce 1 unit of GDP growth. South Korea has an ICOR of about 2.5, China around 3, India ranges between 4 and 5. This means India requires 60 to 100% more capital investment to generate the same growth as more efficient economies. India is currently operating a state-led investment cycle. Government capex has increased dramatically, while corporate profits as a percentage of GDP have also risen. However, infrastructure investment has long gestation periods. Capital deployed between 2022 and 2025 will not fully translate into economic productivity until around 2026 to 2030. During this lag period, capital is locked and corporate earnings growth may slow. Equity markets typically require earnings growth of 15 to 18% to sustain a strong upward trend. However, current consensus estimates suggest earnings growth may slow to around 10 to 12% by 2026. Several factors contribute to this. High taxation can suppress discretionary spending, consumption growth remains modest, and global demand conditions remain uncertain. At the same time, valuations remain elevated. The Nifty 50 trades around 22 to 23 times earnings, compared to a historical average of around 18 times. Mid-cap valuations are even higher. When earnings growth slows while valuations remain elevated, markets typically move sideways rather than crashing. India has experienced a similar cycle before. After the infrastructure boom between 2004 and 2008, the Nifty index remained essentially flat for 5 years. Between 2008 and 2013, the index hovered around the 6,000 level. This stagnation occurred due to delayed infrastructure returns and corporate balance sheet stress. Given the current macro setup, the most probable market structure is a range bound environment. A reasonable range for the Nifty between 2025 and 2028 could be approximately 20,000 to 27,000. Markets may experience sharp rallies and sharp corrections, but without a sustained directional trend. In sideways markets, traditional buy and hold investing often produces limited returns. Instead, active strategies tend to perform better. These include trading volatility, options premium selling, and sector rotation. Government capex beneficiaries may outperform, while consumption sectors may lag until demand recovers. The next structural bull market in India may begin when three conditions converge. First, infrastructure investments begin translating into productivity gains. Second, private sector capex resumes strongly. And third, the global demand cycle improves. This convergence could occur between 2028 and 2032, potentially resembling the powerful bull market India experienced between 2003 and 2007. The key takeaway is this: India's challenge is not the quantity of capital being invested, it is the efficiency of capital allocation. Improving capital productivity may be the single most important lever for accelerating long term economic growth. And for investors, understanding these structural dynamics is essential for navigating the next phase of the Indian market cycle. Thank you for watching.